You just moved to America, you need a car, and there's a sign outside every dealership that says the same 3 words. Sounds like a gift. It's actually a trap, and it's aimed directly at you. Here's the part nobody tells you. That sign isn't there because the dealer feels generous. It's there because you don't have a credit history yet, which makes you the most profitable customer on the lot. By the end of this video, you'll know exactly why zero down offers cost more, not less, and what to actually say when you walk in there instead. Let's be real about who gets this pitch. It's new immigrants. It's international students. It's anyone whose credit history didn't come with them on the plane. You could have had perfect credit in India, Nigeria, Brazil, wherever. None of it counts here. To an American bank, you're a blank page. And a blank page looks risky. Lenders essentially treat new arrivals as an unknown risk, similar to someone with fair or bad credit, even if that person had a strong financial history back home. So when a dealership offers zero down with no credit check needed, it's not charity. It's a business model built specifically for you. Here's the mechanic. Nobody explains at the counter. When you put zero down, you're not borrowing less. You're borrowing the entire price of the car. Every dollar of that car gets financed, plus interest, plus fees. And because you have little or no credit history, the bank sees you as high risk. Without a down payment, you're more likely to face a higher interest rate and fewer loan options, especially if your credit is weak or non-existent. So the offer that looked the most generous on the sign ends up being the most expensive loan in the building. Now here's where it gets worse. A lot of these zero down deals come from what's called buy here, pay here lots. The dealership is the lender. No bank involved. These lots advertise easy approval, but the loans often carry extremely high interest rates that can trap a buyer into paying far more than the car is actually worth. And because you finance the whole car with nothing down, you start the loan already underwater. This is called negative equity, since vehicles start losing value the moment they leave the lot. Starting with zero equity makes it easy to owe more than the car is worth right away, which makes it much harder to trade in, refinance, or sell later. You're stuck. Can't sell it without paying out of pocket. Can't trade it in without rolling the debt into your next car. That's the trap closing. Let's put real numbers on it. Same $25,000 car. Loan A, zero down, stretched to 72 months, higher rate because of thin credit. Loan B, even $2,000 down, same term, better rate because the loan-to-value ratio looks safer to the lender. A high loan-to-value ratio means you have little to no equity in the vehicle, which increases the lender's potential loss if you default, and that risk gets priced straight into your rate. That gap between Loan A and Loan B isn't small. Over 72 months, it can mean thousands of extra dollars just for the convenience of zero down. So what do you actually do if you're new here with no credit file? First, don't take the first offer. Getting pre-approvals from a few different lenders, like a credit union, an online lender, and the dealership, lets you compare real terms before you commit. Second, a co-signer with established U.S. credit can flip your entire deal. It lowers the lender's risk, which lowers your rate. Third, even a small down payment changes your leverage completely. It's not about having a lot of cash. It's about not looking like a zero risk for the dealer, high risk for you customer. Zero down isn't free. It's just debt with better marketing. If this helped you see the trap before you walked into it, hit follow. I break down exactly how the finance industry profits off people who are new to this system, one video at a time.